Hi folks, and welcome to another Trader Cafe with Julian. And today we're doing a macro markets overview. I hope everybody can hear me just fine. I'll get the mic a fraction closer, and we'll get started in just 2 seconds as I get the slideshow uploaded for you guys. So what we're going to do today is we're going to do a round table. So if I'll happy to chat away, and if anybody would like to ask me any questions, then please do. And as we go through this, then we're just sort of what I'm going to do is I'm going to cover off the usual suspects that we have in terms of the markets, and also really just about anything that you guys would like to cover as well too. So let me just make this a little bigger and just hold on 2 seconds while I get myself ready here. Okay, cool. Okay, so let's just move that to there, and I need to move that down here. Everybody can see me talking. Okay. Okay, here we go. Let me share the screen and we will be away. Okay, as always, folks, with the macro market overview, here's how I see things developing. Okay, so on the agenda for tonight, I think really for me the last few weeks has been one of equity markets in Europe and North America pretty much stalling, and I know we've had a pretty rough week in the S&P. There's been no new high this week in the S&P, and we're 4 or 5 days down, I think, in the S&P. Unheard of, the first time since November, I believe, last year, when we are 5 days down on the spin. Although I think there needs to be a little bit of context here. I think we're off about 1.5%. So quite what we classify as anything other than a very short-term corrective move at the moment. Who knows what's going to happen next week? And also, we've really got out there. China is starting to recover, and we'll maybe go and have a look at that, looking at the Shanghai. I won't put up the Hang Seng, but you guys can go and chase that one down. But I'll put up a chart of the Shanghai market, and we'll just see where those Chinese stocks are going. Because I know there's been a little bit of a bad press, really, for China over its equity markets recently. So, as always, we like to look at price here. We don't like to look at what everybody's talking about. That doesn't really help us very much. So We'll have a quick scoot through that as well too. Although when we look at the Chinese economy, it still remains a little bit quiet there. I think credit spreads are still widening. There's some issues with Evergrande, I think it is. I'm trying to remember the name of the Chinese company that's having a few issues. There's a Chinese property company that is not doing very well at all at the moment. And so I think that's one of those things that we have to keep reminding ourselves of, that they're at a different point in the cycle. They haven't put as much stimulus into the markets as we've seen in Western Europe and also the United States. We're going to just revise our Economics 101 about stimulus and the equity market, in fact, equity markets worldwide. And I think the key thing for me, the message continues to be that inflation growth is continuing to fall. So what do I mean by that? I mean that the month-on-month increases are not as great now. So at some point in time, we'll end up flattening out before inflation starts to fall back a little bit, if my thought bubbles are right about where I see the commodity prices and other key drivers behind that settling out in the short run. And within Europe, I think you guys are all seeing this, that GDP growth is starting to stall. Where I'm just going to repeat the message I made last time is I am concerned about this being a Minsky moment for equities in the US and possibly elsewhere. But who knows? You don't sort of see it until that final grain of sand falls on the pile and creates the avalanche. So I also continue to remain bullish in gold and also in the silver market. I know it hasn't been a brilliant week for either of those two products, but we're still fairly confident that if inflation is really a thing for us, then we need to really be thinking about the effect that that's going to have on some of the precious metals markets. And at the moment, with real interest rates, that means the interest rate that you find on treasury bonds, on treasury notes, and take that away from the rate of inflation at the moment, then you've got real interest rates which are pretty negative, which is normally a really good signal for the gold and silver markets. Okay, so key themes. As always, we're going to look through our three key themes, which are inflation. What's inflation doing, and where's that rate of growth of inflation? Fiscal deficits, and whether there's a tapering on the horizon, and I think we've all seen some traffic around that recently. And finally, the pandemic. What does that mean for us, right? Because things are changing there pretty quickly as well too. Some rather staggering case numbers out of the States over the course of the last 4 or 5 days. Guys, so when we start thinking about Economics 101, we get into this space of sorry, just moving my TV around. We get into this space of trying to keep things super easy. And so when I think about GDP or GDP over here, what is that composed of? Well, it's composed of a little bit of consumption, a little bit of investment, or preferably a lot of consumption, a little bit of investment, a quite significant amount of government spending, and also exports minus imports. Now, because economists are brilliant and they have the option of assuming things away, then what we're going to assume in this case is that exports and imports are unchanged from where they've been in the past. It's not quite true, but it's good enough for what we're trying to prove here. So when you look at the last three elements of the equation, when governments are spending an enormous amount of money, where is that money going to go? So they have a colossal deficit at the moment. We know that worldwide. So let's see if we can make this a bit more simple. So that government spending has to go somewhere. So if exports and imports is the same, and the other function, Y at the other end, is pretty much the same, it doesn't take a genius to work out that C, consumption and investment, are going to be some of the prime beneficiaries of this. And we've seen this over the course of the last 18 months. People are buying new everythings, from houses through to cars, through to, in New Zealand, people like their boats. So to boats, to skis, to, you name it, there's been a product that's sold really, really well. And in fact, if anything, we've now got shortages in the supply chain because those sales have been very good. And again, I have to admit, I've fallen into this trap as well too. You sit there and we're 4 weeks into our lockdown here in New Zealand. It's what we consider to be a hard lockdown for Auckland. The rest of the country is out of it, but we're not. And in that hard lockdown, what does that mean? It means I can go to the shops to get food and to the doctors, and that's pretty much it. Oh, and I can get vaccinated too. But that's it, right? So what else do I do with the money that I have, on the assumption I'm still working and I've got money coming in? What do I do with it? I'm going to get on the internet. I'm going to start to buy things. Okay, that's the long and short of this discussion. I think that's really what we have to consider people are going to be doing. So that investment and that consumption is going to be rising. Now, why is investment bigger than consumption? Well, because of course investment can be putting money into the stock market. It can be putting money into cryptocurrencies. It can be putting money into just about anything where you feel the asset is going to appreciate. So think property, think real estate, both commercial, residential, in fact, any type of real estate. So when you look at this, is it too surprising that we're doing that? Well, Not really. The government is running a huge deficit, so that money has to go somewhere. We can increase the Y, but really, in order to increase the Y, we have to get C and I getting even bigger. So you can see why the economy is sort of bounced back, but isn't really doing an awful lot, because C plus I have to be bigger than the G, which is the minus, right? Not quite there. It's called a bit of leakage. But you get the gist of what I'm saying about what's happening in the world. So I think all of this then starts to make sense when you think about what's happened to equity markets and commodity prices and goods prices in general. Things are just more expensive. Well, they are. And of course they are, because the government is spending so much money at the moment that has to go somewhere. What I think is interesting right now, and I love to put this chart up, guys, you and I are going to be living this chart for the next 6 months. And the reason why we're going to be living the chart is because for me, it means such an awful lot, because it's the way that the economists are getting it right or they're getting it wrong. And in this case, here we are with the Citigroup Economic Surprise Index. This is just for America, but the one for the world, the global one, isn't very far behind, and that turned negative this week as well too. So it's essentially the economy is underperforming what the economists think it will do. So it's not to say it's underperforming in absolute terms. What it's doing is underperforming in relative terms to what everybody thought was going to happen. So is that surprising given the events of the past few days? Hey, so one thing when I said at the beginning, and I wanted to pull right into this, right? We looked at China and we looked at America. Okay, so this week we've seen the S&P 500 come off 1 or 2%, literally 1 or 2%. That is it, right? Who knows what's going to happen next? Maybe this is the start of something bigger. But look at that red line on the bottom. The red line on the bottom is the Shanghai Stock Exchange. When we were talking last week, we were down here, right? And already we have moved the best part of 7 or 8%. 7 or 8% in the past 2 to 3 weeks. That's a pretty strong move against the S&P, moving 3% in the other direction. You've had a 10% movement in those two assets. So the one that was cheap is now starting to catch up. The one that was expensive is now starting to get a little cheaper. So that's quite an interesting trend, and we'll watch that over the next couple of weeks. Why is it important? You're asking me. Okay, it's important because as goes China, goes the rest of the world. As goes the US, goes Western Europe. Okay, so that's why it's so important to watch these things as they unfold. One of the other things I think that is really interesting for me is when you put the Chinese stock market on a weekly bar chart. This is the weekly. Yes, 2015, it saw a pretty dramatic rise, and then we had the sell-off when I think the Chinese were concerned about too much speculation, and the market came down. And if you like, you had a panic and discouragement point around here, and then you had your absolute low point here. This, I guess, you would definitely call discouragement on the sentiment cycle. And then you could argue that this was your aversion point, and this is where the market started to improve. So here we are, we're rallying again, and we've now just about to set a new high for the last 2 years. This will be a 3-year high that we're seeing put in place here in the Shanghai Stock Exchange. So for me, that's quite significant, and it doesn't have to go too far. In fact, just looking at that, it's even, sorry, I apologize, that's even higher. That's a 1, 2, 3, 4, 5 year. That's a 5-year high we're about to put in place. Okay, so that gives you some idea of how sentiment is shifting now in China in favor of the economy beginning to pick up again. So we're going to watch that with interest, but there's a difference between the economy picking up and inflation. Okay, when we keep talking about inflation, I come back to this over and over again. I showed this chart I put up last time, and it's a big week for inflation this week, right? Because we got the CPI coming out, I think, on Tuesday in the US. If you look at this, this is the rate of growth of inflation. That just continues to fall. So yes, the absolute level is getting slightly higher, but the rate of growth is falling back. And as you go back, you count your 12 bars here, you get back at some point, all of these negative ones drop off, and then all of a sudden, what will happen is this will stabilize and maybe start to come down a little bit. So we'll see, and we're watching that really closely. So where you see the CPI, the previous one was PPI, so that's producer prices going around. This one is CPI, which is consumer prices. So this is one of the ones which the Fed watches quite closely. Okay, not as closely as it does with one or two other inflation measures, but this is actually quite an important one. And again, if you look at what's happening here, you see overall the rate of change is falling back quite quickly. So is this inflation transitory or is it permanent? So we have to watch very closely to see what's going to come out next week. If inflation stabilizes next week, then I think we can say that this level will be falling back again, and we'll be entering more of a transitory approach, I think, for this. But we see that's why the numbers are so important over the next couple of months to see how they're going to spin out. So what's the bond market telling us? Well, bond yields are stuck. Here we are sitting at, the decimal place is always in the wrong place, guys. So it's sitting, this is the 30-year bond, the key interest rate in the world. It's sitting at 1.9%. So that's a negative yield against that 5% inflation number. Okay, a negative yield of 3.5%. That means if you buy one of these bonds, okay, you lose 3.5% against inflation just by holding on to it for the year. So not a great investment in terms of keeping your money, right? What's really happening here is that your money is depreciating if you buy one of these. Hence the reason why people are buying all sorts of other things instead, because it's better to go and buy something where the price appreciates over time. And at the moment, bonds are quite well priced, okay, with a 195 yield. There's probably a little bit of room to maneuver in there, but realistically, not a huge amount. And with that not a huge amount of movement in there, what does that mean? It means that you're not going to get much price performance, and you're already going to be 3.5% offside with your coupon as well too. So just bear in mind, and I do apologise, it's got 10-year up here, but this is the 30-year bond down here. So when we're thinking about industrial production, I think I might have put this chart up last time. So we're always keeping an eye on what's going on. The German economy is slowly but surely, and there's been no sign of it changing over the course of the last 3 weeks. The German economy is still struggling, even though some of the other European economies are bouncing back. Germany is struggling. In China, when we look at the Chinese economy, is it really bouncing back? Well, not really. It's stuck down here, right? It's stuck down at the 5% level. It just hasn't really bounced back. So there seems to be, as you can see, a secular decline in the extent of the growth in the Chinese economy. Okay, so this is what you need to look at here. This is saying that here it was 15% early on back in 2007, and now we've fallen, 2007, and now we're falling back to where we are now 10 years later, and it's a much lower growth rate that we're seeing in China. Equally, when you look at consumer prices in China, the CPI is just boring. If anything, when you take out food and tobacco, you've actually got declines in the CPI. And I think this is something that's really important. You know, we have, when you look at this, the CPI here is barely above zero, right? Call it 1 or 2%. And in fact, when you take out food and tobacco, because they've had so much trouble with the pig crisis in China in the last couple of years, you've actually got now CPI negative in some cases once you take out that food and tobacco. So again, quite interesting data. And finally, maybe just not quite related to China, but actually it's quite important because it's one of the major trading partners of the US. This is Mexico, and I don't see Mexico industrial production getting back to the pre-pandemic levels for any time soon, right? We're still down 7% on the production levels that we saw for industrial production going into the coronavirus back in 2018. So you can already see we were starting to struggle before we had the COVID crisis, and we haven't really bounced back. Well, we have bounced back, but we haven't really bounced back enough. And then finally, I think something that's really interesting is that something changed in May. This is quite common across a number of markets. If you go and look at a number of security markets, commodity markets around the world, a lot of them had a bit of a pause from May onwards. You know, oil's in there, and I think you can probably see gold was in there too. But also, if you look at some of the other ones, the off-the-run ones, if you like, so think of coffee and sugar and some of the wheat and corn, they all began to mark time and stabilize from about May onwards. So The non-energy ones aren't doing too well, and energy is stabilizing the whole, if you like, the whole core by, well, this is base metals here, excluding iron ore. And again, I've got a couple of charts here that maybe you may find interesting. So this is iron ore futures. So the moment this is saying that the price of iron ore in 3 or 6 months' time is this. Okay, so all of a sudden we had from May in particular, we had in 2020, we had a very big run up all the way through to May of this year. Since May of this year, the market has done nothing but either consolidate with a pretty big move, right? If you look at those moves, you got 220 to 150. That's a pretty big move, somewhere in the region of 30% move. Then it bounced back again, and now it's really truly gone down. So we're at 130 now. 3 months ago, we were sitting at 220. We're getting close to have almost halved the price of iron ore in the last 4 months. So again, I ask the question, where's the inflation? Well, maybe it's here. Maybe it's here because when you look at this, this is the price of coal. So whilst the price of oil, and here's May, right? Here's the point where we were saying things are stabilized. Well, coal during the stabilization was down at $85 a ton. It's now at 160. So there's clearly something going on. And for those of you interested, to go and look at a nat gas chart as well too. There's clearly some big movements and changes going on out there. And I think it's going to be very interesting to see how this unfolds for the next few weeks. But generally speaking, most commodities are actually stalling here. It's just a few exceptions which are still doing very well. Hey, before we go any further, what I'd like to try and do at this stage is to actually do a quick briefing note, essentially, on the increases in shipping costs. Some of you who'll be in the industry will understand all of this and will know this already. For those who aren't, I think you might find this quite useful. I've been looking into trying to discover what the problems in the shipping industry are. We've all heard about the increases and the cost increases. I just wanted to try and get a handle for exactly how those cost increases were coming about and what the key reasons for them for. So I have found 4 key reasons that I think we can attribute most of this to. 2 I've got some charts on. The rest we just have to go with the theory. So if we start with, I'm going to start with point 2 first, which is the change in fuel. So about from, I believe, from the beginning of 2019 or 2020, I can't remember. We get our years confused these days. Sometime in the last 18 months, the world had to switch its fuel to a much more low sulfur fuel. So bunker fuel, which is normally what's used or has been used in the past to power ships, is pretty crappy fuel. It's like the bottom end of the refinery, right? The cracker at the refinery. Not very good, I think, is how we describe it. Full of impurities. Well, the world, because of climate change and because of some sustainability drive, actually put in place the international community some laws saying that we now really want to move to what is called low sulfur. In doing that, what you did is you took out quite a few ships that simply weren't able to run on the new fuel. It was almost too pure for them. I'm sure somebody who's a maritime engineer can explain it, but the long and short of it is, when you put an engine in a boat, in a ship, you can't really change it. You can't just swap it out one day because it doesn't work. You just have to basically write the ship off because it's too difficult to do, because the engines are such a significant part of the ship, and the ship is usually built around those engines. So essentially, they took a lot of ships out of the maritime fleet. So that's the first element, if you like. And I think one of the key things about all of these supply chain issues that we're seeing in the world right now is that things were really pretty tight pre-COVID. So post-COVID, of course, with all the changes and the issues that we've had in different places, that has just exacerbated problems that were probably already there. And if you like, it was called the accident waiting to happen. So how does labor impact this? Well, here's something interesting, is that most seamen are only allowed to work a certain amount of time in any annual year. So, before when you start, you have a year to go. During that year, you're only allowed to work a certain number of days. Now, why is that important? Well, it's important because with the COVID, of course, a lot of sailors have been stuck in ports or outside of ports while they've been quarantining, and they haven't had or been able to take some time off. So in fact, you've got a lot of seamen out there at the moment who are struggling for time off, and that at some point that's going to have to change, right? So that's interesting, but at the same time, and I'm sure every country in the world is having this problem at the moment, there seems to be a shortage of staff in certain industries, and shipping is no exception. So what you've seen is some really big inertia in the labor market for sailors and for seamen. Okay, so when you look at that and you see what's taken place, it only takes, I think, something in the order of every month about 50,000 sailors rotate in the world. There's about 600,000 sailors around the world on the most of the big lines, and about every year, about 50, or every month, about 50,000 of them rotate through. Well, that hasn't been happening. So some are stuck at home because they've either got COVID or they're sheltering from COVID. Some are stuck on the boats because they can't get off. And as a result of that, you've got tremendous inertia happening. And where this causes problems is that people can't be where they need to be to sail the ships. Okay, so that's quite important. So that creates bottlenecks and issues for every ship owner around the world. Third reason is that pandemics shut ports. Okay, we've seen a number of closures from Chinese ports. We've also seen a number of closures for ports in America as well too. For those of you that have been following it, Los Angeles and the Californian ports have really struggled because of the high numbers of COVID cases, meaning that workers can't work, stevedores can't work, and they're such heavily unionized places that are not run by machines that those ports have actually essentially backed up shipping that's waiting to deliver things and can't deliver. When you combine that with the wider COVID problem for supply chains, especially throughout America, there is something like they're just an extraordinary millions of containers that are now in the wrong place and they can't move. So why is that important? Okay, it's important because if the containers aren't in the right place, you can't put them on a boat. If you can't put them on a boat with something in, right, then what you have to do is to work out which containers you can ship things in. And of course, that's why it costs so much more, because you're finding special containers in order to be able to ship product. I think somebody was saying to me the other day that for every 100 containers that comes into the United States, only 40 are leaving. So somebody somewhere is collecting a lot of containers, and probably in the millions. One of the other factors as well too that I find very interesting, and this is where maybe that May date in the calendar is so important. When you look at January to May each year, this is the container counts coming into just the port of Los Angeles. Now, what I find very interesting about this is we're complaining about queues and about constraints and things like that. Well, toss this into the mix as well too, right? So actual container volumes, although in 2020, because of the pandemic, the initial stages of the pandemic, the numbers were down, and they were down by barely 10%. Since then, they've gone from 1.6 million units to 2.4. This is a all-time record for the port of Los Angeles. So it's not really that surprising. There's a lot of boats backing up outside. So think COVID problems, think staffing problems, think the wrong fuel. Okay, think the containers are placed everywhere. On top of that, volumes are going through the roof because everybody is purchasing stuff. Okay, and all of a sudden you can see why there were constraints throughout all of the system globally and why prices for containers were so high. And let's look at those prices here. Prices of those containers were so high because of these constraints. Okay, so if you look at those dotted lines on the bottom, that's the 5-year average for containers. And you can see where it began to light a fire when it broke through both of those two levels. Firstly, from the Shanghai to Rotterdam route, and then from, I guess it began with America, but sort of didn't really move very much. It only doubled to then triple and quadruple. You're talking $2,500 up to almost $10,000 now, and it's higher for getting it to Europe. You can see how those prices of a 40-foot container have really moved. And that's, if you like, the average prices. There are some which we're hearing is a lot higher than this, but I wanted to put this in front of you really to say, Is it surprising that we saw PPI and we've seen CPI begun to tick up? Well, no, it's not really. So why are they happening? They're happening because of these supply constraints. And if it costs you 4 times as much to ship product, what are you going to do with that? Who's going to pay? Well, the end user is going to pay, which is you and me. And so that means that margins will be maintained by the distributors and they'll just pass the costs on. So unsurprisingly, that affects inflation, right? The issue is it going to keep going on from here? And the answer that I'm hearing out there now is the short answer is no. It started to come back. So we would expect for the same January to May period next year for this to be lower. So when we're looking at our key themes, okay, we've got inflation. I still believe we're in a transitory, well, modestly transitory point until proven otherwise. We still are maintaining the fiscal deficits. I will make a point of order here to say that some of the central banks are now talking about tapering in a way that they weren't before. I don't quite understand why, the Europeans especially, but, you know, okay, if that's what they'd like to do, then give it a go. See how you get on. But unless you've got fiscal deficits balancing and helping out, then I think you're going to find very quickly that growth isn't going to recover. And finally, the pandemic and the changes in the pandemic. And I just wanted to put 2 charts up for you here. This is really, for me, a tale of 2 continents. So here's the Italians after the terrible trouble they had at the beginning of the pandemic, and look at where they are now. So they had this is Delta, and again, case counts have fallen away as everybody's got vaccinated. Compare that to the States. This is the rise of Delta and the unvaccinated infections, people who are getting hit, the daily new cases. Last week, Friday, the daily new cases, I thought it was a typo. It spiked to over 500,000 new cases, right? This is crazy, okay? Absolutely crazy. They're at 40 million cases now. At some point in time, everybody's either going to be vaccinated or have immunity, but I don't see that at this stage starting to change. Hopefully it will, and hopefully we'll see the numbers change, but this doesn't bode well. So is it surprising that the world is slowing down, that economists are seeing a slowdown? Not to me. But just remember, guys, I put this up every single time because I think it's so important. Whatever we think is going on, we just have to make sure we're looking at the price. So our theories support the price action. Okay, if the price is going in the opposite direction, then we have to respect that and trade with the price. May not trade as big, but you trade with the price. If it's going in our direction, that's when we can take the opportunities. Okay, and again, look, finding out what's going on in the world is not that hard. Knowing what to do as a result of it is probably also not that hard. Knowing when to do it, that's the bit that's really hard. So I tell you what, once again, let's go look at our Super 6. Okay, what we're going to do here is we're going to go through, I probably ought to put crypto in this, but I'm still a bit reluctant to. We might go for a sexy 7 or something like that. But let's stay with the Super 6 for the time being. Let's go through the different sectors and just try and get a handle on what's going on in the world. So overall, I think the euro is still waiting. The dollar is not crashing. How does that sound? The dollar is not crashing despite everything that's going on. The dollar is not crashing. So we have to continue to play the waiting game with the euro. And the yen is even worse. We've got a seasonal influence which is bearish, so the Japanese yen should be strengthening, but the technicals at the moment are just really hard. Maybe there's an opportunity coming up because it's been really flat for very long and is due a breakout. So, and normally when the yen breaks out, it does tend to reinforce itself. And then finally, just one of my favorites for the crosses as well, to the euro sterling. Nothing is a surprise there to me about euro sterling, and I continue to hold my view that we're going to trade lower in that product. So when we start to look at this is the euro, and this is a daily chart. Of course, the last 3 or 4, the last 3 or 4 years. So this is a weekly chart. I apologize. I think it'll be a weekly chart. It will be, because there's a daily chart there. So this is a weekly chart of the euro, and as you can see, for the last few weeks, we still remain in this dollar bullish, euro bearish trend. Are we just marking time in a huge trading range, which is a possibility? Now, when I say huge, this is a 6 big figure trading range. That's not a lot. When you look at some of these moves here, we've moved from 125 down to 112, and from 125 over the course of 2.5 years down to 107. That's a slightly bigger move. At the moment, we've gone up and we're still stabilizing. Okay, do we then turn down again? Well, that's the big question. So when we look at the daily charts, the recent trend is down. We've had one retracement here that got sold again to a new low, and then we've gone down to another new low. What I'd like to see, as you all know the way that I trade, I'd like to see a higher low in here somewhere. So we need to maybe go down. If we are going to go up in the euro, we need to establish a secondary low that's higher than the low that we see down at 116.60. Then it may be getting interesting. Until that point, it's still a downtrend. Play it that way. When I look at the Japanese yen, again, what are we seeing here? We're just seeing a whole heap of nothing. This is triangles on triangles, right? You can draw the triangles in as well too. You don't need me to draw them in for you. Here we go, but I will anyway. There's the triangle that you've got in front of you. No secret here. And in fact, if anything, I think you could probably argue that it's like this and maybe like this. You know, crikey, something's going to happen soon. This isn't the time to be selling volatility. Something's going to happen soon, but it's awfully quiet. And guys, if anybody's listening and you have any questions, just shout out. Okay, now I've realized I need to get rid of the drawing tools. Because I need them to go away. And they won't. Here we go. How do we do the eraser? Fascinating. Clear all drawings. That's the one we're looking for. Okay. One thing I wanted to point out to you guys is there's still a strong seasonal pattern in dollar yen, a strong seasonal pattern for dollar yen to fall. So I'm going to risk it again. That's the strong seasonal pattern. We have to bear that in mind. That lasts through until this time in mid-October. So from mid-October, then we change our view on dollar yen. Until that point in time, we still have the probability of tracking down. Now, how would that demonstrate itself? Well, what I'd like to see is a break of these lows or this low. Crikey, we've got loads of them, right? We need to see some price action here to justify this seasonal bearish view. We had a downward move. We've got a ring tie up in place here. We've had a downward move. We've had the bounce back. You could argue if we open up here or we open here, then we start to see some weakness. It might persist. Maybe this will be the time when we break out of the triangle, but who knows? It's on watch, guys, so just keep an eye on it, and let's keep watching and see how we get on. Right, when we look at some of the other markets, this is just a quick scoot round. This I think is the is euro sterling, and just really going nowhere, quite frankly. And I haven't changed my view about this. I still think that price is going down. Okay, right. So when we think about oil and commodities, I'm just going to repeat my argument that I had from last time. Okay, so inflation growth, if it is subsiding, I think commodities ought to consolidate, and we're beginning to see that. X of coal, which was going crazy. We did see that iron ore chart coming down, and iron ore is a pretty important product for China, the exports to China. So if you like, it's one of those key elements. Coal at the moment, not so. Coal is more of a internationally led shortage that we're seeing at the moment rather than anything else. So when I look at this, in the medium term, is this still positive, this whole demand supply balance? I think my answer to that is always the same. The commodities that are going to be focused on the decarbonization of the world and the electrification of the world, they're going to be looking good for a while. Add into that, I think oil as well too. I think oil has got a reasonably good opportunity to rally over the course of the next 12 to 24 months. I think it's too cheap where it is, and it will go higher, possibly much higher. And again, if that was to happen, whilst that would be good for the price of the commodities, that would be deflationary for the economies. So let's have a look at oil. Okay, here we go. The key thing about oil is this is the seasonal bearish time starting right here. Okay, so we've got about 2 weeks, 2 to 3 weeks, and then we start the legs, the seasonal bearish time. So what do we think is going to happen with oil? And guys, isn't it amazing? Every single year, every single time, here we go, 2021 was no exception. This seasonal bullish pattern in oil is known about and has been known about for 40 years, and yet again the market rallied. How much did it rally? It went from $46 all the way up to $74. Is that enough for you? That's like a 80% move, right? 80%. Okay, I know it's not quite crypto, but that's still not bad, right? So yet again, behaving exactly as it should with the seasonals. When did it top out? When the seasonals topped out. Look at that. Almost the exact same time as when the seasonals topped out is when oil topped out. And we've seen this happen. So if that is the case and we're tracking the seasonal pattern, I wonder what is going to happen this time. Are we going to follow this down, or are we just going to consolidate around here? And that will be a key determinant of what is going to happen next when we get into the tail end of the year. Because if we can only consolidate in this area here, or we do reasonably well, then that is very bullish for next year. So when we look at the daily chart, again, it's a little bit all over the place, right? This is the last few days. I'm not sure what you've got here apart from a whole bunch of outside days almost. You know, there's an outside day pattern there. There's another one here, and we almost printed another one here. The only thing it's got going for it, this was the highest close for 1, 2, 3, 4, 5 days. Okay, so that's interesting. Maybe we get follow through to the upside on Monday. We'll all be watching that. As I say, I remain fairly positive about the oil sector. We've had the A, B, C major decline. So here you've got A, then you've got the bounce back B, and then you've got the decline C into this move here, which is clearly some kind of final move. And then from that, we're now starting a more positive pattern. If we revert and head down here again, this gets more complex. And then I have a problem with the oil market completely, right? We may be starting a new trend. Until that point in time, we remain relatively positive. So key positive areas, it doesn't really need to go below 67. That's our number, right? $67 on WTI, right? We should not go below that. Below that, all bets are off. Okay, we take that out. I would then be cautious. I'm not going to write cautious here properly, so I'm not going to bother. Guys, you know what I mean, okay? So just remember, oil so far is trading okay, given this move here. It needs to break out. What about our old friend gold? Well, last week wasn't a great week for gold. We tried to go up to new highs. We then started to reverse, maybe a little bit in line with the seasonal pattern. We almost topped it out with a seasonal pattern to the day again. I think there were a couple of days too early this time. But it's been a bit of a good run from August through to September. We're still in a medium-term bull market held together by these lows here. We take those lows out, bull market's off, no bull, okay? Okay, but if we can hold it in here and hold this area here around the 1775, right, key support, right, that still gives us the opportunity for the market to maintain its bullish bias. That's where I'm seeing it now at the moment. Let's see how that unfolds over the next few days, okay? And as I said last time, gold, I think, is at an interesting point for a possible significant rally. I talk about the Minsky moment. I really recommend you guys go and look this up. And I think just try and get an understanding for how the convexity of markets works. So what do I mean by that? I mean, boy, oh boy, if this thing starts to fall, it could shock us to the extent at which it falls, right, in the space of 2 or 3 days. So here's the S&P. We've had 5 days down in the S&P. I think 1, 2, 3, 4. Well, not quite 5. Let's call it 4 days down in the S&P. This is the first time that's happened for ages. This was only 3. How many do we get down here? 1, 2, 3, 1. I'm not going to bother going back. You guys can go look it up. But in terms of percentage move, it's tiny. We barely got down to the latest support level. This is like, so the first support that I would see in this market is this price point here. That's the first support point. Beyond that, you're then down into this area down here. Okay, and then possibly here as well too. That's the low of last month. That's pretty critical. And then the low of the last quarter down here in May at 4,200. The way the market works these days is entirely feasible. We could do all of that decline, which has probably got to be in the region of 10%. Not even that. Oh my God, that's only a 7% move, right? We could do all of that in a day. I mean it, guys, in a day. Okay, we could wipe out 3 months in a day. Okay, now what is stopping us out there at the moment? One of the things that's slowing things down is the put-call ratio. So here's the thing, right? For the amount of money that you get on the S&P, here's the S&P trading level as it stands today, right? This level here in price terms, right, will cost you X. Let's call it 10. If you want to buy some puts on the S&P, the same price level in terms of distance, so this distance here equals this distance here, okay, the same distance, okay, that today will cost you 40. So there is a colossal skew to the market at the moment. The put-call ratio is completely out of whack. What's happening? Everybody is long and they're all buying protection if the market falls. That's what's going on. You think, oh gosh, well, there's lots of people buying puts. That's why they're so much more expensive. So if they're buying puts, they think the market's going down. So if they think the market's going down, it won't go down because all these people need to lose their money. No, they've got it hedged against all their colossal long positions. That's why they need these puts. It's entirely feasible that if they make money on these puts, they'll lose a lot of money on their underlying stock positions. So I don't see this as being a drag. It is not the reason why in the past, when we've had things like this pitch up, the market's gone down for a couple of days and then immediately bounced back and gone to a new high. Okay, I don't see that happening this time around. Okay, no new highs this time around. This could be the start of something. Let's see what happens. I'm always skeptical. And what do we always do? As you guys know, because I keep saying it, we trade the price action. At the moment, it's bearish. Live with it. Okay, so what do? You look to try and sell bounces. That's what you do. When are you wrong? You're wrong when you take out some of these levels up here. Right, there's the short term, and then all-time highs will be the next one, right? I don't believe in either of those at the moment. So for me, I think the market's got a bit more work to do to the downside to go find some buyers, possibly down here, maybe down here, but that's going to be pretty fast. The seasonal pattern is still negative through to the middle of October. So we've got a bit of a way to go yet. Let's see what happens with this. And again, I just want to reiterate the bond market as well too. It's doing nothing. Even after that sell-off in stocks, it's still doing nothing. So when we look round, we got the euro watching. We're watching it at the bottom of the trading range, right? The US, the dollar yen decline is probably the highest probability, but who knows? Waiting for the breakout. Okay, oil. What? This is like a broken record, right? Still consolidating. Gold. Okay. This is an important point down that 1775 level, but it's still a bull market till we take out that 1660. S&P, Minsky moment risk, convexity in the market. Again, I just keep coming back to this over and over again. Why are US bond yields so low when inflation is so high? Somebody's wrong, and it's usually never the bond market. Guys, thank you very much for listening. You've been awesome. As always, does anybody have any questions? Because I really have to spend some time working on my hair, I think, for the next macro market message. Cool. Okay, guys, no questions. Look, thank you very much, and I will see you again next week. Take care, everybody.